Hello, my name is Carrie Lentz, and I'm the District Vice President for Edmonton East at TD Canada Trust. TD is very proud to sponsor Eric's New Women's chapter of the Career Mentorship Program. This program will feature a series of modules designed with women in mind for professional growth and personal wellness. Please check back each month for new and exciting installments. Enjoy!
First one is mortgage. And so a mortgage is basically a loan that's backed by real estate. I always make this joke with even my team. So the term mortgage, I think it was initially used in Britain back in the day. And it comes from, I think, a Latin word, don't quote me on that, where, it basically means it's going with you to your graves. So the idea is, because mortgages normally would take a long time for people to pay off. That's why the term, right? And the funny stories that I make with it. But that's the idea behind it. The other thing you want to know is down payment. So down payment is the initial upfront payment that you're saving and you're paying towards your home. So for instance, let's say you want to buy a home worth $200,000 and you have $20,000 saved, like our RSP example. You can use that. And rest of it will be a loan from the financial institution. The next one is amortization period. So amortization period is the length of time it will take you to pay off that loan to a zero. Now, given the interest rate remains the same, which it doesn't most of the time, but just kind of give you an idea of, your amortization period is 25 years to pay off this loan. So just something to keep in mind. Whereas a term is a portion. So a term is basically the length of time that you're committed with that particular mortgage, financial institution. So for instance, in an amortization, you may have 5 terms or even more. Most of the terms are about 5 years. So for 5 years, you're only dealing with that bank and, kind of keeping that interest rate and the terms associated, unless you kind of pay a penalty and break it. So that's the idea behind that. Fixed rates do not change during the term. Remember, we talked about the term, like most usual is a 5-year. So it would not change during that 5-year term. So, your payment, so let's say if your payment is $600 a month, and out of that, $400 goes towards your principal, so paying down your principal, and $200 towards the interest. It remains the same. Your payment remains the same, no changes to that. Whereas a variable, the rate actually varies, and it varies with Bank of Canada prime lending rates. So if you've heard it in the news in the last 1 year, the Bank of Canada prime lending rate declined significantly a few times. So the people who were in variable rate this time last year, their rates are probably lower right now. But that's when, we're going through a pandemic. And there's a risk that comes with variable rate, right? So let's say if the rates go up within that 5 years, your rate will go up as well. And what happens with your payment is your payments won't change, but more will go towards the interest, of course, because the rates are more now. So it'll take you longer to pay it off. Now, recommendation, honestly, first time when you're buying a house, it's always recommended to go fixed rate. Peace of mind, unless you have a crystal ball and you can kind of, say where the rates might go next year. It's always advisable to go fixed rate first, just to get started, just to kind of know the process. And then, variable, if it goes down, it's good. If it goes up, it's not good. So you don't want to take that chance, especially if you're not too well aware of what's happening out there. It's always recommended to go fixed rate. Once you have, like the terms that we talked about, you've established a good credit history, you have saved for your down payment in the RSP, like we spoke, and you know how much you can afford. So basically your income, you have a job and, all of that nice stuff. What you do next is try getting a pre-approval. So what a pre-approval is it kind of gives you an idea on what's the value of the house that you can afford based on your personal circumstances. So you're based on your income, your credit history, your down payment. It helps you make informed decisions. So not just going out there and looking for a house worth, let's say 600,000, but if you can, if your income and all your personal circumstances allow you to buy a house worth, I don't know, 300, 400, 200, that way you're only kind of targeting the houses that are within, that are affordable to you. And then, so, again, it gives you peace of mind, kind of, convenient for you to know what you can afford. The other good news is with the pre-approval. So at TD, we will, once we do a pre-approval for a client, we can hold their rate for 120 days. So let's say, you get a pre-approval today, and within 4 months, you find a property, we'll actually even hold your rate. So let's say if the rate goes up in the market, your rate doesn't go up. And on the flip side, if the rate goes down, we can actually, try and negotiate that as well to go down. So actually, most of the times we can absolutely go down with the lower rate. So it's a good idea to, to get pre-approvals just for the peace of mind. Some of the financial institutions, they'll also let you do pre-approval online. Again, your choice. If you want to go in and see someone in person and do it, go ahead. Like, I understand it's a very important financial decision. So if you want to talk to someone and do it, you can absolutely, walk in and do that. Next step is, if you're already working with a real estate agent, or if you're, looking for private deals, depends on, what your personal circumstances are. But most of the real estate agents, they'll kind of, ask you for it. So if you let them know, hey, I'm pre-approved for 200,000, they'll only be looking at properties up to 200 or 300, let's say, up to that amount, something that suits your pocket and suits your needs as well. So they'll help you find the property. Now, what's important is, let's say you like a house and you're putting an offer to buy it, make sure you put a condition on there. It's called financing condition. So what that means is, you ask for a week or 2 weeks from the buyer, and you tell them, from the seller, and tell them that, give me 2 weeks until I confirm it with my bank. So you come back to, financial institution, and what they'll do is they'll turn that pre-approval into a live deal. So what a live deal is, they'll put the address of the property, they'll also do an appraisal and make sure the house is actually worth the money you're paying for it. So all of that, because of course they have a loan against, right? So they want to make sure it's actually worth that much. So those are the couple things to keep in mind at that point. So my recommendation is prepare your family and dependents for situations like these, like COVID, right? Or out of the blue. But if you're prepared for it, we'll be in a better shape. So protect your financial security. So you're prepared for it no matter what. And how do you do that? Is, my recommendation is, if you are getting a loan, make sure you're protected for that loan. So even a car loan, a mortgage, a house loan, make sure you're protected against it. So for example, some of the financial institutions, they will offer some kind of, an insurance around creditor, it's called creditor protection, around the debt that you're taking. So I like to think of, the insurance payment as part of your mortgage payments. So if your mortgage payment is $600, consider it $620, $20 for the premium. Because it's important you have your financial security and your family secured in case things were to go south. The other cool thing, if you were to get a life insurance early on, so when you're younger and you're healthier, the premium is actually really low. So, it's not as much as it would be, when I turn 55. So just certain things to keep in mind, and always have yourself and the family protected. Doesn't matter if it's, through the same financial institution that you're getting the mortgage from, but as long as you're protected, that's important.